From the financial centers of the world, this is Bloomberg Markets with Alix Steele and Guy Johnson.
It's 30 minutes into the U.S. trading day, Wednesday, August 23rd. Here are the top market stories that we're following for you at this hour. Drop-kicking Foot Locker. Investors punish the stock after the company cuts its full-year forecast, dragging down its peers. And the pause point. Services start to roll over. Does the data from Europe and the U.S. give central banks permission to pause? We're going to talk to Ralph Schlosstein, Evercore Chairman Emeritus. An anomaly or trend, weakening services data, a 10% move around Nvidia's earnings, and a baby giraffe born with no spots. We find out which is more unusual. It's a great full screen. All right, from New York, I'm Alix Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Guy made me put the giraffe, and I found a way. to put the giraffe in the cold open. You are welcome. Happy birthday.
I've been thinking about it all morning. It's not my birthday, but I wish it was. Yeah, fantastic to get the giraffe in. We've just got to talk maybe about the Yankees and the fact that they've lost 9 in a row. Maybe 10 coming. Haven't seen that since 1913. Let's talk a little bit about what's happening with the PMI data. It is going to appear as if by magic behind me. And these data are not exactly great reading. The economies look like they are slowing down on both sides of the Atlantic. The US data, the latest to drop, but the European data earlier certainly giving us a reason to pause and think about what is happening here. Remember, not only on Friday do you have Jay Powell speaking, but you've also got Christine Lagarde, the president of the ECB. Is the data out of Europe going to change the way that she perceives maybe the path ahead? France, look at what these are the comp numbers. The services numbers are where the real story is. But France, 47 to 46. Germany, 48 to 44. 44. These numbers are getting painful. Eurozone, 48 to 47. The UK number dipping unexpectedly as well, Alex. These are not good numbers. They point to contraction. The data certainly signaling that the ECB has a lot to think about.
Yep, and it's the same here in the U.S. Before we get to that, though, just some breaking news for you. The SEC is imposing new hedge fund and private equity fee disclosures. We're going to have more on this in just a moment. But we're waiting for this to come down. The agency is going to have some finalized sweeping plans later on today, but they're seeking to curb preferential treatment of certain investors, and there are going to be some fees that are in disclosures that are coming down. So hold that thought for just a moment. Also in the U.S., just to echo what Guy was talking about, manufacturing and services rolling over, still above 50 for both, but it looks pretty dicey. And finally, you're seeing the services data roll over. And the question was, is it going to roll over to meet manufacturing? And I wonder if we're starting to close that gap. And that also is a little bit different than what we've seen in terms of retail sales, et cetera. You can see the US services PMI, which is the one you really want, is that pink line just around that 50 level. So anyway, clearly, things are weakening. We were going to blame it on us going over to you, Guy, for holidays. But look, all over the place, services are rolling over.
Absolutely. So what is the take? How should central banks read this data? Let's get some instant analysis. Chris Williamson, S&P Global Market Intelligence Chief Business Economist. These are his data. Chris, if I'm Christine Lagarde and I'm looking at the numbers that you posted this morning, is this permission to pause, as Alex put it?
Permission to pause. Look, it's certainly raising the bar for another rate hike in September. This is signs that the pain is really coming through now in terms of higher interest rates. We get this from the survey respondents. They're ascribing these downturns in demand to customers feeling the pinch from interest rate hikes as well as the increased cost of living. Interestingly, though, you can also see some comparison with Japan. Japan, where rates haven't risen, the service sector growth is really strong still. It's one of the strongest that we've seen in the history of the survey there. So it's a clear indication that in Europe and the US, these service sector downturns are being generated now by higher interest rates.
Right. So Chris,
clear now.
The real question is the feed-through mechanism, and here in the U.S. it comes in the form of the labor market. Is that leading through to companies cutting jobs in manufacturing and services?
Not cutting yet, but starting. In manufacturing, the payroll cull is underway, but in services, it's not there yet. But across Europe and the US, we now have a near stalled job situation in August as companies are looking at their order book situation, thinking, hang on, we just need to stop hiring.
Where does that get reflected in wages? Because I look at the numbers, And the wage component is what is driving inflation. Any inflation that's in the system seems to be coming from wages right now. When does that employment story translate into less onerous wage growth?
Yeah, well, there's obviously a lag there. The theory is, of course, that you get your labour market tightening, and then people can negotiate up wages. So there's a delay in that happening. We've seen that on the upturn. What we're seeing now is the very first stages of that coming and reversing. So we've got the pullback in hiring, stalled labour markets. This is going to start feeding through to lower wage demands.
Chris,
that's the theory.
How quickly, Chris, can the data and all that roll over? Like, how quickly can services roll over? How quickly can wages roll over? How quickly can input prices roll over?
It will happen quite quickly. We're already seeing a big pullback in the inflation rates in the service sectors. Yes, there's some stickiness there, but they've come a long way over the last year. It looks like everything's holding it around the 3% level. That's our indication that we've got at the moment. So when inflation's coming down, it is sticking there. That wage growth in particular is holding it up. But with the labour markets coming down, you've got perhaps a 6-month period whereby you'll get that filtering through to lower wage growth. The job of the central banks, of course, is trying to time everything right. But look, here you've got a whole treasure trove of data giving you almost real-time information saying, look, what you're doing is happening. There's a delay of policy feeding through, but it's there. The impact is there. If you do more, you're going to get more pain. And that's going to risk a deeper downturn in activity.
Can I just go to the national trends briefly, Chris? Is there any sign of the weak story that is being generated by China at the moment showing up in Europe, particularly in Germany?
It's adding to the pain. It's certainly adding to it. We get some reports of that coming through, but it's more broad-based than China's weak economy. There's a big inventory reduction going on at the moment as companies realize they're overstocked relative to demand. That's one of the biggest influences on manufacturing. It's one of the things got to look forward to going forward. When is that cycle going to start turning? It's not turned yet, but we do expect that to be quite imminent. But that's the main thing rather than China, I would argue.
So obviously the reaction is very much go buy equities. You're seeing yields plummet. You're seeing the dollar down. It's sort of a nice bond rally that we're seeing and move into equities. So it's all sort of pointing to the fact that central banks are going to need to be done. If they don't pause, Chris, what does this data look like in the next 3 months?
If they don't pause, well, we can expect the output numbers to continue to weaken, deeper downturns. I mean, at the moment, some of these readings are quite dire historically. So if you ignore those early downturns in the pandemic, Germany's readings are the worst since 2009. In the UK and the Eurozone as a whole, the worst since 2013, US stagnating. But these are consistent with sort of stalled or 0.2, 0.3% GDP contraction. So nothing major at the moment. But if you keep hiking, these are going to get worse, and you are going to get a Q3 downturn, feed through to a Q4 downturn, recession, and that's going to hit confidence further and cause a deeper problem.
Yep, hence the 2-year yield down by 9 basis points. Chris, great stuff, really appreciate it, and that rally being led really by Europe as well. Chris Williamson, S&P Global Markets Intelligence Chief Business Economist, thank you so very much. Some breaking news for you also. We have new home sales for July coming in actually really strong, an annualized rate of 714,000 homes, up by 4.4%. So that data, retail sales data, some of the read-through we're getting from retail, doesn't necessarily match up then to the services now that we're seeing roll over. Speaking of jobs market, really important. The Bureau of Labor Statistics just out with payroll revisions, and it's going to be revised. It will be revised down by about 360,000 in the preliminary estimate. Joining us now from more is Bloomberg's Michael McKee. Mike, can you put this number into context for us, please?
Yes, every month the Bureau of Labor Statistics reports on the number of jobs that were created by surveying companies around the country. And then once a year, they go back and look at the tax records those companies have to file, and then they can rebalance the numbers to get a more accurate count. It only goes through March of this year, the year prior, from March to March. And as you mentioned, 306,000 fewer jobs likely created during that time period. It will be officially attributed it to various months at the beginning of the year, and each month probably will be a little bit lower, but it is smaller than expected, the drop smaller than expected by economists. So it does suggest that there's still strength in the labor market, and that what we saw over the last year was not any kind of mirage.
Mike, is there a horse just out of shot? I'm wondering, is it there? Am I about to hear it kind of winnowing? The hat, I think, is very impressive. It goes very well with the Jack. You are perfect. The Jackson Hole setup works very well. Mike, it is an incredible image. I don't really know how to talk about the data when you are in such a fantastic place with such a fantastic hat on, but I must. Is this number bigger or smaller than we anticipated? Is this ultimately going to change the trajectory for the Fed in any shape or form?
No, because it came in lower than expected, and it basically means that by month there may be 20 to 25,000 fewer jobs. But remember, we were creating during that time period around 300,000 jobs a month. So at this point, it isn't really going to have a major effect. What is going to be interesting for the Fed is they take a look at these PMI numbers, and of course we'll see next week what the ISM shows us, and then you take a look at new home sales. We're getting this bifurcated economy where there is strength in some areas, weakness in other areas. We're expecting the long and variable lags to hit now, so there should be some weakness, but it's not across the board. So what do you do about raising rates at your next meeting? And I would think that Friday we'll hear Jay Powell say, we're just going to keep an eye on things. We don't have to decide till September 21st. We'll look at all the data.
Data dependent, data dependent. It's so beautiful there that it doesn't even look real. Like your background looks like a green screen. It's so beautiful. All right, Mike, really appreciate it. Thanks for jumping on. Bloomberg's Michael McKee. Okay, get back to that breaking news from the top of the hour. The SEC imposing changes on hedge funds and private equity firms on fee disclosures. The move is meant to curb preferential treatment of certain investors. Well, joining us now, Bloomberg's Sonali Basak. Sonali, is this what we expected?
There are a few things we did expect, to the point that you're making. Increased fee disclosure for hedge funds and private equity firms. This is a $17 trillion industry that has faced some regulation, but now you're watching the SEC under the Biden administration really start to grandfather a new era here for regulation for an industry that has just blossomed. To the point you're also making is that part of this is to limit preferential treatment, sidecars. The idea of giving larger investors, longer standing investors, better terms has really become common practice. And what now Chair Gensler is saying is that they're looking to make sure that one group of investors is not bearing an outsized share of benefits in terms of fees being reduced relative to other investors. Something interesting about this also is that if there are complex deals to cash out those investors sooner rather than later, or to transfer positions from one fund to another, which again has become fairly common practice, they would need an independent auditor to ensure a fair deal across investor bases. Now, there are some wins here for the industry. We've seen hedge funds and private equity firms lobby very aggressively against this rule, which will be voted on today by a 5-member commission.
Yep.
Two of those wins include the indemnification clauses, the idea that investors can sue more easily. They were going to try to lower it from ordinary negligence to ordinary negligence from gross negligence. That is not in the final rule. Another win for the private equity and hedge fund industry here is that there is a grandfathering provision, which means that existing rules and existing arrangements that are in effect with their investors can remain in effect. So these are going to be new rules.
Yep.
And so clearly some wins for the industry here. The MFA, the Managed Funds Association, has said that they could sue within a couple of weeks of this rule being voted on. Let's see with these wins if they continue to do that, given how much they have fought these rules.
It does sound awfully like a draw to me. Like that's if you were to put this on a scoreboard, this looks like a draw. Is that the case? And is this just an example of hedge fund lobbying? This feels like there's been an awful lot of influence exerted here to make sure particularly those two last bits didn't go through. I'm sure hedge funds lawyers are pretty disappointed here, but everybody else must be pretty satisfied, and maybe that was money well spent.
There are some real wins, but remember, this is a private industry that has enjoyed being private, and that was some of the draw here. The Managed Funds Association is a very powerful group. The Founders Council includes Bridgewater, Citadel, AQR, Balyasny. What they do from here will be interesting because, again, these are pretty landmark rules that are being created for the industry that even with those wins, I'm sure they don't want.
Yeah, they got maybe some of what they wanted. Shonali, fascinating. Thank you very much indeed. We'll wait and watch and see those lawyers sharpening their pencils, and maybe we'll see some action very, very shortly. I still can't quite believe that Alix didn't reference the hat that Mike McKee was wearing. Anyway, maybe some hat jealousy. We'll talk about it later. The whole outfit was fantastic. I know. He's nailed it. Anyway, we are going to take you back to our question of the day. Do PMIs point to a pause? Kiran Ganesh of UBS Global Wealth Management joining us next. We'll see if he's wearing a hat. This is Bloomberg.
The economy remains very resilient.
Data just continues to be very, very resilient.
Growth so resilient.
Equity markets remain quite resilient.
The U.S. consumer still remains extremely resilient.
It certainly looks as if third quarter is going to stay pretty resilient.
The economy appears to be on solid footing.
All this talk about a recession so far hasn't panned out.
I think we've gotten too optimistic on the growth front.
There is some complacency.
Market complacency.
People being very complacent. That usually leads to some sort of natural pullback.
It's really hard to see material upside to equities.
Over time, higher for longer should slow things down.
We still have this mild recession in the forecast.
We are going to have a recession at some point.
At some point, you're going to start to see things break.
Are things starting to break? Some of the guests on Bloomberg television talking about the debate about what is happening with the US economy right now. Clearly there is some resilience, but maybe the cracks are starting to widen. Today's PMI data, less followed in the United States, but I still think relevant. Fascinating. A slowdown appears to be certainly in train in Europe. How deep is it going to be in the United States, I think, is a key question. Do the PMI data that we've seen today point to a pause for the ECB, for the Bank of England, for the Federal Reserve? Kiran Ganesh, UBS multi-asset strategist, joining us now. The US data has been incredibly resilient. Do the PMIs change that? Is there a kind of permission to pause within that data? And what about Europe? What are you seeing in Europe? The data is certainly starting to signal quite a significant contraction potentially in train for the ECB.
Well, it's important to take a step back and see what this data is showing, right? So it's showing us that the economy is slowing. That's something we had expected, and it is likely that the economy is going to be slowing below trend. Does that mean we're going to enter a recession? Does that mean we're going to have a crash? No, we think the data has been resilient enough to prevent a recession at this stage. And in terms of central banks, we do think they're going to have to hike a little more because inflation is still elevated. So we're looking for perhaps one more hike from the ECB and the Bank of England. And we'll see what Powell has to say later this week. But we think he will leave the door open to a further rate hike because of that resilience we've seen in the US economic data.
Karen, if the data rolls over a little bit more than we thought, I feel like the soft landing or no landing scenario, we may need to rethink those phrases. If we do, where's the pain trade?
Yeah, so we think that bond yields have got quite a long way to fall. We've been quite surprised the extent to which bond yields have remained elevated, despite their optical attraction in terms of their yields, and despite the fact that clearly they can fall a lot further in the case that we see economic data slowing. So we think that trade of being long bonds right now, we think is a good one to have on in case you do see that further slowdown. It's important to remember that although a soft landing looks likely, this isn't a Goldilocks scenario that we're heading towards.
So if you're in cash right now, and a lot of people are, you want to be thinking about some duration. How far out do you go?
Yeah, so we're looking in the 5 to 10 year segment as the best positioning in our view, because you're locking in those yields over that time frame. Certainly within that frame, you're likely to see some kind of recession at some point in the future. And there, if we do see that slowdown, because you've got that duration in the portfolio, you're going to see some rally, which could offset some of the declines in other assets like equities.
So is the read-through for the dollar then? Should the dollar be weaker? Because that also feels like that could be a big pain trade.
Yes, a weaker dollar is certainly our expectation here. A lot of people today focusing in on those PMIs in Europe and selling the euro, selling the pound because of that economic weakness in Europe. But we think it's important not to forget the inflation picture, which is still more elevated in Europe. We think we're going to have to see more interest rate hikes in Europe relative to the US. And in terms of market pricing, people are very optimistic in terms of the outlook for the US economy, and that means the dollar is overvalued in our view.
Pivot points are really hard to predict. This year has been massive on the uncertainty front? You think you've got a narrative nailed down, it switches on you. Then you think you've got that one nailed down, it switches on you. What's your degree of certainty right now? What's your kind of, what if you were kind of looking at the bell curve and the distributions and the kind of the sense you have and your sense of certainty about where the middle lies, how great is it?
It's low but has improved, I would say.
Okay.
So I think we had very low levels of certainty earlier in the year when we had these massive interest rate increases, some notion that they're likely to have a negative impact on the economy, but really no data to show what impact that would have. Now we're quite some way on from those interest rate increases. We at least know what they haven't done so far, and they haven't caused a recession. The economy has remained resilient. So I think we can be a bit more confident in the soft landing scenario. But the fact that the impact has been so small, I think, is leaving that residual uncertainty because it feels like the impact should have been bigger. So I think there is still a sense of uncertainty, but perhaps lower than it was a month or two ago.
Well, Guy, you know, I feel like this is a perfect segue, Guy, to talk about options because that's what you've been seeing, right? Like put options have been used. Yep. You have the single-day options expiration as well, which then can be responsible sometimes for late move swings in the equity market, like to your exact point.
I think it's just been incredibly difficult to follow. I think you've got all kinds of uncertainty manifesting itself from kind of the very short term in the options you're talking about, all the way out to kind of 6-month, one-year horizon. You would have expected a 500 basis point hike in rates to have had a bigger effect at this point. It hasn't. It's like a firework. You've lit the blue touch paper. It's kind of one of those fireworks that kind of fizzles. And you're waiting for it to go bang. It hasn't gone bang yet. Do you go back to it? I don't know. What do you do? Of course you don't go back to it. But who knows what's going to happen at that point? Yeah. So I think that there is. I still think we're at a pivot point that has the potential to go bang. The soft landing narrative that Kieran's talking about, yeah, still possible. But we'll wait and see what happens.
Yeah, which is exactly why I love the services data that came out in terms of the story that's painting that, like, how quickly can that roll over? If it rolls over quickly, then we have a different kind of scenario when it comes to a soft landing. Okay, we got to leave it there. Kieran, thanks a lot for joining. Kieran Ganesh of UBS. We appreciate your time. This is Bloomberg. We're about an hour into U.S. trading session. Equities around the highs of the session. That's sort of bad news, good news thing, which is definitely all over the stock market after those weaker than expected services PMIs. Abby's looking at it. What do you got?
Well, we've certainly got a lot of green on the screen here, Alex. We're looking at the first time that we've seen 2 up days out of 3 days this week in the month of August, because it has been this big down month. But investors really pretty encouraged, and it is one of those bad news is good news stories. And you can see it's right across the board. NASDAQ 100 stocks, and then the China tech story. It is also rallying despite some of that weakness there, down up 1.5%. Now, the real driver from a market's perspective, of course, it has to do with yields. We've had this relentless backup for yields. Yesterday, we had yields come in just a little bit, at least on the longer end of the curve. But today, take a look at this. You have this 10-year yield down almost 10 basis points, back at a 423 or so. So investors liking that lift. It takes a little bit of pressure off of valuation and going with it right now. The relief rally, so to speak, on the S&P 500, though, as we've been talking about, below about 44.60 in that 50-day moving average. That near-term downtrend still in effect, but this is definitely a nice lift day. Now, taking a look at what's happening beneath the surface in the world of retail, it is a tale of 2 stories. Foot Locker not helping out at all. In fact, this is a record decline. The worst day going all the way back to when this company first started trading publicly back in 1980, down 33%. They cut their guidance by about 33% on profits, so it's a likewise decline. They also suspended the dividend, not great at all. Abercrombie & Fitch, on the other hand, absolutely soaring. It was a good quarter. The guidance was good. Their namesake brand was good. And there was a return to growth for Hollister. And then finally, if we switch up the board, we are going to take a look here at one sector that I have not, this is kind of like a stealth decline in a way, Alex. If you take a look at this banking sector over the last 8 days, down 7 of those 8 days, down 8.1% over that time period, despite the fact that you have yields climbing. And I think it has a lot to do, of course, with these downgrades that we're having of some of the smaller and mid-sized banks.
All right. Abigail, thanks so much. Really appreciate it. Yeah, also looking more regulation, et cetera. We appreciate that. All right, it is 32, almost past 7 on the West Coast. We want to get to the startup where we cover the top tech stories from the Bay Area and beyond as Silicon Valley starts its fiery morning. It looks like that is a very odd looking background there, Ed. Ed Ludlow joins us now. Ed, I want to talk about Peloton for a second.
Yeah.
It's down 20%. How much of that is execution versus real lack of sales, or what?
All of the above. I mean, we've discussed on the startup for a really long time about Peloton wanting to move from being a hardware company to a subscriptions-based company, a software-based company. The big factor in their fiscal fourth quarter was that they had the recall for the seat post, 2.2 million bikes were impacted, and what happened was 750,000 people, way more than they expected, came to them and said, yeah, actually, we want you to fix my seat post. The knock-on effect was that it hurt that transition because between 15 and 20,000 subscribers hit the pause button until their bike was fixed. They weren't interested in continuing to pay the sub, and that was a really big net contributor to the overall subscriber loss, which was about 26,000 in the quarter. So the story's not gone well for this company in trying to turn from being a hardware to a software-based company.
So Ed, you are always the person that I think of when I think about Peloton. You've got one.
Thank you.
You're coming to the end of it. You're probably not going to replace it. No, you have been. It's been interesting to see the arc that you've been on in terms of your usage of the bike, and I'm wondering kind of what changed. This company clearly was a lockdown kind of a lockdown special. It did incredibly well during that period. Where did the execution really start to go wrong after that? Why weren't they able to capitalize on that?
Not just the execution, we'll get to that real quick. Control room, if you can, bring up a 5-year chart of the Peloton stock, because the Peloton charts, the stock story matches my story and everyone else's. This record high was on January 13th, 2021, which we all accept to be the sort of mid-peak point of the pandemic era. It's August 23rd, 2023, and we've hit a record low. And you know, along the way, Peloton had supply chain issues. When people started transitioning out of their homes into the gym, they had a pricing issue because they, at the sort of mid-range of the pandemic, wanted to go towards the premium product.
Yeah.
And it's just continued its slide down lower and lower. And at the same time, those difficulties with hardware have not been able to be outshone by a focus on software and subscriber base.
So Ed, what confuses me is to the extent that the market's hitting the stock. Like, these are things we knew, right? So I'm just wondering what that says about positioning and sentiment going into some of these numbers.
Yeah, I think, you know, this is the biggest drop since, on an intraday basis, August of 2022. At one point, it was the biggest drop since a midpoint of 2021. So clearly, I think expectations were elevated. The net result was their financials are taking a big impact, right? You know, the guidance for revenue is is up to 600 million at the high end. That's significantly below the average analyst estimate, and it's showing us that everything from higher costs that they're facing through to the recall, through to what I talked about, subscribers hitting pause, it's really impacting growth. And that's the key point. I think goes back to Guy's question as well.
Yep.
You know, Barry McCarthy's not been able to return them to growth, no matter what story you tell about what the company actually is.
I remember in advance of Tesla earnings that Ed would almost be fizzing with excitement. Are you fizzing with excitement? For the Nvidia numbers and that call, and what is going to happen? The options market's got a huge swing priced in.
10%, right? That's the way that I look at it, right? The options market says a 10% swing. This is a company that is between 3 and 4% of the S&P 500 on a weighting basis. But if it's the pure play for AI, if the pure play to get exposure to AI is to invest in Nvidia, it tells us whether the AI story has staying power. You know, we know that loads of companies committed CapEx to, at least on the data center and server side, get the best AI-related chips, which Nvidia actually makes. The way to think about it is that AMD and Intel, its big rivals, AMD's made announcements around its very AI-specific GPUs, but they're not yet in the real world, whereas Nvidia has 2 generations of GPU actually in customer hands, really powering AI development. So we'll get a good sense if there's a forward cycle of that. Does it continue? One warning, supply. You know, TSMC is their contract manufacturer of choice. Were they able to get the chips from TSMC they wanted?
Yeah, the bar is so high that any kind of inkling of an issue on that supply side front, I think, is going to be magnified significantly. Ed, I'm looking forward to the coverage later. I know you're going to be all over this. Bloomberg Technology is coming up as well. We're looking for that in around 90 minutes' time. Ed and Caroline building you up to that key moment. Nvidia is going to be fascinating. Let's carry on the chat and talk about what is happening here. Srini Pajuri, Raymond James, senior analyst, joining us now to discuss you've got a strong buy rating, not just a buy, you've got a strong buy rating. You've got a price target of 500. Talk to me about how high the bar is. Kind of what would constitute a cause for concern tonight, Srini?
Yeah, sure. Thanks for having me. Yes, the bar is quite high. And part of the reason is, the way they guided last quarter, coming into this quarter, we were expecting maybe the company will guide about 5% over expectations, but they guided 50% over expectations. So that, as we call the rest, it has been, that pulled the entire market up. And there's been a lot of buzz about AI since. And we just raised our estimates recently, and I've seen many of my peers do that. What I would say is that demand is not an issue right now. The supply constraints are the main issue. If you look at the hyperscale companies, most of them, the likes of Microsoft, Google, and Facebook have all reported. And if you kind of listen to their calls, even though the overall spending has kind of, seeing a mixed trend, everyone said they're shifting their spending to AI-related projects. So the demand is there. And, supply has been the main issue. In normal times, can you hear me?
Yeah. How important for you are the numbers going to be versus how the stock trades on it, considering how much is in the price and what the options market is looking at?
Yeah, the numbers are important, but for me, if it is a supply issue, we wouldn't worry too much about it because, one thing they said in the last earnings call is that their demand visibility is extending by a few quarters, meaning, until the end of this year. And our expectation is that this earnings, they'll probably say demand visibility is extending beyond the end of this year into next year. As long as they say that, we're not too concerned about, lack of, again, we're talking about how much upside here. I don't expect them to miss numbers or miss anything. It's more about, where the expectations are, especially in the buy side, and how much upside they're going to report and they're going to guide to. So as long as they talk about visibility extending, I think the stock does fine.
Is this stock sensitive to anything else? I'm wondering whether there's a macro kind of overlay here. Is there a Powell overlay here, or is this just a pure play? We've got a huge lead. We've got the GPUs in people's hands. We can monetize. We're maybe a little bit capacity constrained, but the picture going forward is so bright, it's blinding.
Yeah, right now, I don't see a major issue in the short term. What I would say is that there has been some concern about potentially additional export restrictions on China. And management has previously said that China is roughly 20 to 25% of their data center business. But they didn't seem too concerned because the demand elsewhere is so strong. So in the short term, I don't see a major issue. But longer term, you're right. AI is so early. There's been a lot of spending. We have to somehow see the monetization. It's early days. I think it's, the adoption is spreading across industries. And we are confident that there are going to be a lot of applications out there that enterprises will be able to monetize. But that's going to be something that's going to be closely watched.
So we were saying your price target is 500. We're actually not that far away from that number. And I'm wondering how quickly you think we get to that number.
It all depends on where the estimates go. As I said, we raised our estimates and we argued that there's probably additional upside in the short term. As estimates go, this is a stock that traded in the low 40s on average over the last 5 years. And there's no reason why the multiples will compress all that much. So as long as estimates are going up, I do expect, the stock and the price targets across the streets to go higher as well.
All right, Srini, thanks very much. We really appreciate it. Srini Pajjuri, thank you very much, of Raymond James. Some sad news to bring to you now. Laszlo Birinyi has passed away. For 5 decades, the famous investor shared his thoughts on the markets. He made his name, of course, at Salomon Brothers, where he was responsible for his weekly commentary. His trading manual was cited in Liar's Poker by Michael Lewis. In 1989, he left Salomon and formed Birinyi Associates. It is with great sadness that we bring you that news. Laszlo Birinyi was 79. This is Bloomberg Markets. You are looking at live shots of the principal room. Coming up, Republican presidential candidate Nikki Haley will be joining Bloomberg Television tomorrow at 10:30 New York time, 3:30 p.m. in London. Thursday. Don't miss that. This is Bloomberg. So we get services rolling over from the PMIs and more retailers coming in, and it paints a pretty murky picture for me. So on the one hand, you got Foot Locker just tanking, dragging down other sportswear makers. They wind up missing its estimates and suspending its dividends. Meanwhile, you get Abercrombie and Fitch boosting its full-year outlook. Apparently, customers are flocking back to the apparel brand, and also Urban Outfitters did really well. That was a shocker for me. Bloomberg.
Is that where Mike McKee got his shirt from?
Urban Outfitters? Definitely not.
No, Abercrombie. The sort of the check thing. I'm just wondering.
I don't think that's no, probably somewhere in the Midwest. Definitely not Urban Outfitters, unless there was like some super cute, trendy thing on the sleeves. I don't know. Simone Foxman is watching all of this for us. Can we start with Foot Locker? This kind of echoes what we saw yesterday from Dick's. What are we learning from these names right now?
I think Foot Locker, the main message, weak consumer, slower than expected back to school sales. That's a really important time for Foot Locker as well. And more broadly, they're on this turnaround plan. And this is a really bad way to kind of kick things off. That was announced back in March, but now we're seeing this weak consumer, and that's pulling down athletic wear overall. Nike shares, Nike shares Under Armour sales off, kind of in sympathy with this trade. Dick's, is athletics overall really under pressure?
Athletic out, prep back. So what's happening, the preppy look back? So walk me through Abercrombie. It's not just Abercrombie, it's Hollister as well. My kids certainly know the Hollister brand pretty well. They kind of like the Abercrombie brand. I can see how they could get back into that as well. Why is one going in one direction and one going in the other?
You know, it seems like people want to spend on certain things and not on others. So Abercrombie has really tailored its products these days after, this dramatic sort of fall from grace and then trying to reboot itself under the aegis of CEO Fran Horowitz. It's now trying to target younger millennials, allow them both work and play sort of attire. And it seems to be really succeeding. I remember being in like middle school and Abercrombie was all the things. So it does seem to be back because these are the strongest second quarter sales since 2011 and share price really reflecting that, the strongest in a decade.
Yeah, I don't know if I categorize Abercrombie as preppy, guy.
Really?
I don't think that's preppy. No, I'm looking on their website. I would not say this is like a J. Crew is preppy.
In my day, J. Crew I appreciate, but in my day Abercrombie was also quite preppy as well.
But I don't think
maybe
so. I'm
maybe I just got it all wrong. Okay, yeah.
But maybe preppy is a little bit more what can mediate between work. You can wear. It's nice enough you can wear it to certain jobs, perhaps millennial jobs, service sector jobs. But you can also kind of wear it to play. It's not completely too much too buttoned up.
Okay, fair enough.
Or buttoned down.
Or unbuttoned. I don't know. There's lots of ways we can go with this as I scroll through their website. So to that point, though, I'm wondering what we learned about the shrink, which really hit Dick's. Did we hear anything about that from any of these other retailers, or can we say that was a Dick's real issue this last quarter?
So this was mentioned, not just by Foot Locker as well, but also by Bath & Body Works. Foot Locker saying, this isn't such a huge thing for us. It's bad, but it's not so bad. Bath & Body Works talking about how this is worse than it had anticipated. The trend line is down. That said, last quarter, Target was the one who was really calling out shrink as a huge hit on their earnings. Apparently had underestimated sort of the overall impact. Now this quarter it really seems to be Dick's Sporting Goods, but it's hard to tell. I mean, how much of this is companies just didn't plan appropriately? How much of this is an upswing in the amount of shrink? I mean, I was looking back yesterday, there were plenty of stories from 10 years ago about the impact of shrink being significant, organized crime, in retail space. It's unclear exactly how much larger the impact is now than it was then.
Okay, I'm going to admit I'm looking through the website. To be fair, the last time I went to an Abercrombie store was the one all the way down by the heliport in Manhattan. That was it, but that must have been 20 years. I think it was the same time that I bought the Birkenstocks.
Yeah.
Honestly, I think it may have been the same trip.
Yeah, times have changed just a touch.
There's a lot more it's a lot more hoodie than I remember it being. So there's a lot of hoodies in there.
Birkenstocks with the Abercrombie and Fitch.
It's entirely possible, Simone, that may have been the case.
Oh, God, you're killing my soul. Go to break. Go to break.
Simone, thank you very much. This is Bloomberg.
Time now for Wall Street Beat. We're going to take a look at what's buzzing on Wall Street and the world of banking and finance. And today, we're going to start off with Bank of America's trading desk, gaining ground on their peers. It's one of the top read stories on the terminal. It's a real deep profile into sort of the changing landscape of their trading business. And Sonali Basak is here as always. Okay. Big dramatic changes that are actually paying off.
They really are landmark changes, and people talk about trading as a sleeping giant over at Bank of America. Post-crisis, they were not willing to take on that much risk. But then you have this new guy. He is Jimmy DeMare. He came from Citigroup in the wake of the financial crisis over to Bank of America, and he is really the man to watch over at Bank of America. Last 4 quarters in a row, you have the big boss, Brian Moynihan, giving him a shout out in each of the earnings calls. Remember, in 2022, they had their highest full year in sales and trading revenue since 2010. So significant jump, which has given him more faith from his bosses to bring on dozens of new people, as well as get more capital allocated to that business. Now, as Bloomberg's Catherine Doherty points out in this profile, this has led to about a 6% share over JP Morgan, which is the biggest of the group. But if you even look at its share relative to Citigroup, for example, in fixed income trading, last year you saw a trading jump of 10% overall at Bank of America versus a 7% jump at Citigroup. So they are really keeping up with the giants.
So are all the people at Bank of America working 5 days a week? And is that the difference?
Well, you know, there's a few things.
Well, in the office.
In the office, yes. I think for Bank of America's business.
In the office.
Yeah, well, you know, I think what's interesting about the office part of the story here is that if you look at a bank like Bank of America or Citigroup, they're hiring across the entire globe. And the Bank of America and Citigroup kind of back to office story, therefore has to account for all of that. I think you're referring to another very, very, very popular story on the terminal right now, which is about Goldman reiterating it's 5 days a week back in the office. Kind of in the commercial break you and I were talking, hasn't this been known? Of course it's been known. They want people back every single day. But at the same time, you're watching not just Goldman, but other banks also keep a stronger handle on this. The irony right now, I think, is that we're at the end of August and many of the buy-side clients are not in the office. In fact, some of these buy-side clients, many of them, Ares, Blue Owl, they have work from anywhere policies. So you have people who were previously in New York that are working on a beach in Greece, for example, through the summer, as they wait for Labor Day rush to come to the fore.
I hear the Wi-Fi in Mykonos is pretty good at this time of the year, so at least maybe they're getting a good connection. Sonali, great stuff. Thank you very much indeed. Bloomberg, Sonali Basak. Let's talk about what is happening with the markets right now. The PMI numbers are having a big impact. We're waiting for Nvidia, clearly, but the PMI data from both sides of the Atlantic certainly having a significant impact. Stock 600 up a little bit. We're up by around 0.4%, but look at the bid back into the bond market. UK 10-year down by 17 basis points today. PMI data out of the UK, out of France, out of Germany, out of the Eurozone. Not looking too clever right now. Christine Lagarde speaks on Friday. I've been saying it all week. That's the story. Wait for Lagarde. This could be the surprise. The other story I want to mention as well is Adidas or Adidas, but what do I know? Adidas, Adidas down by 4.73. The ripple effect coming off Foot Locker is huge right now, and it's certainly rippling across the Atlantic, and Adidas is suffering. That stock, as I say, down by nearly 5%, but Foot Locker obviously down significantly more. There is much to discuss with our guest in the next hour. Ralph Sostein, Evercore Chairman Emeritus, joining us to discuss Powell, Nvidia, AI, what the long-term story for these markets looks like right now. Ralph is coming up soon. This is Bloomberg.